Hey everyone, Nick Nielsen, Certified Financial Planner. Thank you for joining me on today's webinar, The Math of Recovery. Unfortunately, today the markets aren't quite as high as they used to be, but we have hope and faith that we'll be higher in the future. How long will it take? We don't know. Maybe it's 6 weeks, maybe it's 6 months, maybe it's 6 years. We never know how long a recovery will take. However, is there an opportunity? Today's video is going to focus mainly on the math of recovery. So in this picture here, I drew that the markets have gone down 30%. What will it take to get back to even? It's a 43% rate of return. A couple other key numbers to look at. If your investments were to drop 40%, you would need a 66.7% rate of return to get back to even. If the market were to drop 50%, you would actually need a 100% rate of return to get back to even. I want to go through a couple of scenarios using a 60-40 portfolio. We'll make a couple of assumptions. Bonds return zero. The stock market has just lost 30%, and that will need a 43% rate of return on our stocks to break even. I chose the 60-40 portfolio because it's a pretty common portfolio that we see in pre-retirees and retirees alike. And let's assume we start with $1 million, 600 in stocks, 400 in bonds. We've just experienced a 30% stock loss. Our 600,000 in stocks is now 420,000, which makes up approximately 52% of the portfolio. If we then get a 43% stock market gain, we will be back to even, $1 million, 0% total return. If we took that 820,000 after the 30% stock loss and just rebalanced to our original 60-40 allocation, and then the stock market goes up 43%, not only do we get back to even, we've made a little bit of money. In the example here, 1 million will grow to $1,031,560, or approximately a 3.16% rate of return. What if we look at increasing equity exposure? And instead of rebalancing to a 60-40 model, we change to an 80-20. Maybe we're inclined to buy more when things are on sale. In that example, 656 of our 820,000 would be invested in stocks. If the market were to then go up 43%, we would then have $1,102,000 at that point, or approximately a 10.2% rate of return. Our final example, what if we put the whole $820,000 in stocks? Then the market goes up 43%. At that point, I'd have $1.17 million, or approximately a 17.3% rate of return. I've included a summary slide here to show that the more equity exposure you add to the portfolio, and then if we get the big snapback, you'll see the corresponding rates of return. What if I'm wrong? Probably the most common question that comes up when I go through the math with someone. So let's assume that 60-40 portfolio has experienced the 30% drop in stocks. It's now worth $820,000. We put it in the all 100% equity portfolio. The market goes down, or the stock market goes down another 20%. It drops to $656,000. That might be a lot to stomach. But at the end of the day, if we get that correction and the market gets back to its initial levels, you could be rewarded. You'd be back to the $1.172 million. My thought, you've gone from 1 million to 820, you've already experienced the pain. If you think we're going to get back to even, or even better, it might be worth considering taking on the additional equity exposure. Warren Buffett has a great quote. Every decade or so, dark clouds will fill the economic skies and they will briefly rain gold. When downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons, and that we will do. Obviously, Mr. Buffett has been a pretty successful investor over the past 50 years. For us, we just have to determine when these dark clouds of economic uncertainty arise, do we want to have our wash tub or the teaspoon? Adding equity exposure may not be right for you and your plan. We'd love to have a conversation with you and hear your story and help you figure out what's best for you and your plan. Feel free to contact us. You can reach us at 704-243-9376, or you can email us at knowmyplan@lpl.com. Check out our website, knowmyplan.com. Thanks for checking out our webinar today, and we look forward to hearing from you real soon.